If you own a townhome in Ottawa, it's worth about 5% less than it was a year ago. If you own a detached home, it's actually worth slightly more. Same city, same month, opposite direction. The July numbers from the Ottawa Real Estate Board recently dropped, and the story is not market up or market down. It's a split, and which side of it you're on changes what you should do this fall. My name's Eric Beckers with Beckers Realty here in Ottawa's South End. And in this update, I'll show you what actually happened to prices, how much inventory is really out there, where the demand went, because it's moved, and the real math on upsizing from a townhome to a detached house right now with actual dollar figures. I'll also give you an honest read on the two things that everyone's whispering about: the federal job cuts and whether to wait for the next Bank of Canada rate decision on September 2nd. Stick around. The numbers get more interesting the deeper we get. If any of this hits home for your situation, the easiest next step is a quick call. So link in the description to book your complimentary discovery call. Let's dive in. Here's July in one breath. 1,325 homes sold across Ottawa, almost identical to last year. Benchmark price sitting at $634,000, down 0.5% on the year. Sounds boring, but it isn't. Split it by property type and you're looking at 3 different markets. One wearing a trench coat. Single family homes, the benchmark is 725,000, which is actually up 0.7%. And sales on these are up 5%, with 714 detached homes changing hands in 1 month. The townhomes benchmark is 542,000, which is down 5%. Condo apartments benchmark 385, down 5.2%. And taking a median 41 days to sell, roughly 2 weeks longer than the rest of the market. So when someone asks me, is Ottawa dropping? My honest answer is, which Ottawa? If you own detached, your market is holding its value and it's actually getting busier. If you own a townhome or a condo, you're the one the headlines are actually about here. All of this is straight from the Ottawa Real Estate Board's July release and the MLS Home Price Index. Now, the numbers that you're seeing in every headline is the average price, $683,308, down 1.6% from last year. Be careful with that one. The average moves whenever there's a mix of what selling changes. More condo selling drags it down. More detached pulls it up. That's why I watch the benchmark price instead. The benchmark tracks the same typical home over time, and it says down 0.5%. This is not a correction. That's a market catching its breath. 2 more numbers that actually back that up is that the total dollar volume in July was $905 million. This is flat, and homes are still selling at 97.8% of asking. Sellers who price right are still getting their number. Sellers who price at 2022, they're sitting. Now let's move to inventory, because this is where the market has genuinely changed. Active listings are at 4,678, up nearly 10% from last year. This is 3.5 months of inventory. The 5-year average is only 2.5 months. So buyers have meaningfully more choice than they've had in years. If we zoom out a bit, 8,288 sales year to date, down 5.2% from last year at this time. So the full year is running slower, even though July held. Put those together and you get an honest picture. It's not a crash, it's not a boom, it's a rebalanced market where your leverage depends entirely on what you are buying or selling and where. So this brings me to where. In July, over 70% of the Ottawa transactions happened in the suburbs. The core is soft. Central Ottawa is sitting at about 5.5 months of inventory, and only about 4 in 10 new central listings actually got sold. The western suburbs led the absorption at 56%. Out here in the South End, it's a different market again. Greely's average sale last month, about $1.1 million. Riverside South and Findlay Creek keep turning over because that's where growing families are actually landing. So when you read a national headline about a slow market, understand what happened in Ottawa. Demand didn't disappear. It relocated away from the core toward more space. This brings me to the move that I help with the most: the family leaving a townhome for a detached with some land. Here's the real math on this, with real numbers. Your townhome benchmark is 542,000, down 5.1% like we said. So yes, you're selling into a softer market than last summer, and nobody loves hearing that. But the detached home you're buying sits at 725,000, up less than 1%. This didn't run away from you. The gap between those two benchmarks is only about 182,000. Now, finance that gap. Variable rates are around 3.35% this week, and 5-year fixed around 4.09. Now, if we run that 182,000 over 25 years, this costs roughly $900 a month ballpark before taxes and insurance. Send your mortgage broker the exact prices for your scenario to get your personal numbers, but this is reasonable to upgrade. 2 years ago, you were financing that same gap at close to 6%. Call it $1,165 a month. The gap didn't shrink, the cost of carrying actually did, by more than 20%. So the question isn't, is this the perfect market? It's whether roughly $900 a month buys your family the yard, the garage, and the space that you're already wishing you had. Now, this is a 20-minute conversation with your personal numbers and not the city average. If you're buying your first home or your next home, July actually handed you something that we haven't had in many years. Median days on market hit 28, up from 22 in June. 6 extra days doesn't sound like much, but this is the difference between offer tonight, waive everything, and let's sleep on it. Go back for another showing, do an inspection. Inspections are here and back in full force. Financing conditions are back, and on the right listing, negotiating the price is also back. Remember, homes are closing at 97.8% of list, which means the average buyer is getting a little bit off. 2 years ago, writing a conditional offer on a Findlay Creek townhome was the quickest way to lose. Today, this is normal, so use the room while it's here. On the flip side, if you're the one selling, especially a detached in the south end, don't let balanced market scare you. Your segment is the strong one. Benchmark is up, sales up 5%. Price right, homes still fetching 97.8% of asking. But the game has changed since 2021 because buyers now have 4,678 listings to compare against yours. 3 practical moves need to happen. Price to the last 90 days of sold comparables. Not your neighbor's asking price, not what you need to get, but what the market tells you. 2, presentation matters again. When buyers have 3.5 months of choice, the homes that show best win the offer. 3, expect conditions in offers. An inspection isn't an insult. This is the market and you need to get used to it. And if you're selling a townhome to upsize, remember the math from earlier. What you give up on the sale side, you claw back on the buy side and on the rate. The sellers who struggle this fall will be the ones pricing to a spring 2022 memory. Now, the segment that nobody wants to own right now or wants to talk about, condos. Benchmark at 385,000, down 5%, 5.4 months of inventory and 41 days to sell. If you're selling a condo, price to this market, not the one you bought in. If you're a first-time buyer, flip that around. This is the most negotiable corner of the Ottawa real estate. The one place where you can take your time, compare, and negotiate like it's your job. If you're thinking investment, go in with open eyes. Vacancy rose to 2.7% from 2%. CMHC's last rental survey actually flagged the biggest jump in new rental supply that this city has seen in almost 50 years. The cash flow math is tighter than it was. Now, here's the last section that's important. 2 questions behind every conversation I'm having. First, the federal job cuts. City staff reported this spring that thousands of public servants have faced layoffs or buyouts, and unemployment in Ottawa is currently rising. This is real, I'm not going to pretend otherwise. So why isn't the housing market falling harder? Let's look at which segment is holding. Detached homes in the suburbs. That demand is life stage driven. A family that's outgrown its townhome doesn't stop needing a 4th bedroom because of a headline. The segments that run on investor and first-time confidence, condos, smaller townhomes, are where the softness shows. Now, I'll keep updating this honestly every single month, whichever way it continues to move. Second, should we wait for September 2nd? It's the Bank of Canada's next announcement. Here's what we know, not what my personal prediction is, but what we actually know. They've held at 2.25% 6 times in a row. Markets are pricing in basically no change. I don't predict rates, and I'd be careful with anyone who does. But waiting on a quarter point that may never come while the right house sells to somebody else is a trade that rarely pays off. Make the decision on your numbers, not on the Bank of Canada's calendar. So if you're anywhere in that upsizing conversation, or you just want to know what your home would actually sell for in this market, book a call with us today. The link is in the description. We'll run your real numbers and you'll leave knowing exactly where you stand. And if the South End is where you're heading, watch the next video. Here's what 1 acre in Greely actually costs you. We talk about land, septic, and stuff that nobody tells you until after you've offered. The link is right here.